All right, everyone. So we're going to continue here with chapter 3, which is on account types. So I want to cover this before we get too far into fundamental analysis, which is chapter 4, and technical analysis, which is chapter 5, because inevitably some of you are already thinking about setting up an account and how to sort of start doing some of the legwork around getting ready to trade. So part 1 of chapter 3, we're going to talk about different account types for traders, and day traders specifically. We have cash accounts, we have margin accounts, and we have retirement accounts. Those are the 3 account types. Now, these are going to be the 3 for all U.S. traders. I, of course, recognize that a good portion of our students are international traders, and you may not have the same retirement account options that we have in the U.S. You may not have any, or you may have others that I'm not aware of. So obviously, you would know perhaps better than I would, or you could certainly speak with a local accountant about what your retirement account options are, or even contact one of the brokers and ask what the options are for a Canadian resident or a European resident of whichever country. So first, let's just talk about professional and non-professional. Now, you may have already crossed this bridge when you signed your market data agreements to utilize our scanners right here, because these scanners provide you with real-time market data, and we have to pay for the use of that data directly to the exchange. And so the exchange wants to know, well, is the person using the data using it in a professional capacity, or are they non-professional? And so the question is here, do you have a license? Do you have a Series 7 or Series 63 license? If you do, you know you have it. And if you don't, then you're not a professional trader in the eyes of the exchange. And this is all about the exchange trying to get the most money for market data. That's really what it is. They charge professional traders more money for market data. They charge retail traders significantly less money for market data. So if you're not a professional trader, and most of us are not, then when you go through the questionnaire, they say, are you using this for your personal use? Yes. Are you using it, for, professional use or in exchange for something? And the answer is almost always no, 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 no. So I just want to get that out of the way early on, because that's also a question not only that we ask you as we give you market data for the scanners, but that a broker like Lightspeed will ask you, because they're, of course, providing you market data, and they need to know how much to charge you for that, because then they remit that amount to the exchange. And the exchanges they want to get the most that they can, and they will audit brokers and double check, and so brokers always have to be careful to make sure that they have people labeled correctly. Okay, so with that, the first account type is a cash account. Now, a cash account is an account where you deposit $1,000 of cash, $5,000 of cash, whatever it happens to be. You deposit a cash amount, and every time you take a trade, you have to wait 2 days for that trade to settle before you can take another trade. Now, that used to be a 3-day settlement period, and then a little while ago they switched it to a 2-day settlement period. Maybe it's possible that they'll change it to a 1-day settlement period, which would be nice. But for right now, as of the time of this class, it's still a 2-day settlement period. So that means if you have a $3,000 cash account with TD Ameritrade or with E-Trade or even with Lightspeed, you could buy $3,000 of stock in 1 day and sell it. But then you can't take any more trades until that $3,000 has cleared and settled. So you could trade on Monday, then you can't trade on Tuesday, you'd be able to trade again on Wednesday. Then you can trade on Wednesday, but you can't trade on Thursday, you can trade again on Friday. So sometimes what traders with cash accounts will do is they'll trade with half of the balance every day. So if you have a $3,000 account, you trade with $1,500 on Monday. That amount of money you'll be able to trade with again on Wednesday, and you'll be able to trade with again on Friday. The other $1,500 you trade with on Tuesday and on Thursday, and then again the next Monday. And while you certainly can do that, trading with only $1,500 and not having the benefit of margin and leverage, which we're going to talk about in a moment, would make the process of growing a small account certainly a bit slower. And so most traders would not opt for a cash account. Most traders, including myself, would opt for a margin account. And so a margin account allows you to trade immediately. You do not have to wait for the trades to settle to retrade with that same amount of money. Now, the trades still take 2 days to settle, but your broker knows you're good for it because trades always settle. It's not like you get a bounce check with stock trades. They always settle. So they just say, yeah, that's fine. Go ahead, keep trading, keep generating commissions and everything else. We know that that's good for the broker and everything else. So keep trading, and we know you're good for it. Don't worry about it. You do, however, have to sign a margin agreement with the broker, and that margin agreement essentially is an agreement that you are trading on borrowed money in a sense. And so you have the amount of money you put in the account. Let's say it's $25,000, and you could trade with that $25,000, 500 times in one day. You could trade $5 million of stock in one day if you wanted to. They don't really care. I mean, you may generate commissions depending on which broker you use, but you can just keep trading and trading and trading. So 99% of active traders will use a margin account. However, as we talked about yesterday in brief, when I was talking with you guys a little bit about the Great Depression, I mentioned that in the past, you were able to trade on not just margin, but even borrow money to invest in the market. And that when you were borrowing money to invest in the market, you could do it at a ratio of 10 to 1 and even higher. Well, that's no longer the case. And what's also no longer the case is that you have to have a minimum account size in order to be able to trade an unlimited number of times a day. And this is a rule that was implemented in February of 2001. And we're going to talk about that in a moment. So before we get into that, let's talk about leverage and buying power. So all margin accounts, when you sign your margin agreement, you are getting 4 times leverage. So that means if you put up $100, they'll give you $300, which means you can really trade with your cash amount times 4. Now, that's important to understand because what it allows you to do, and this is why it's called leverage, it allows you potentially, let's just think out loud and sort of do the math here. So let's say you have $10,000 in your account. All right, so I'm going to go split screen. So you've got $10,000 in your account. All right, so $10,000. Now let's just forget about the rule of $25,000 for a minute and just focus on the 4-to-1 leverage. So with 4-to-1 leverage, therefore, you would have $40,000 in buying power. You could buy up to $40,000 in stock. Now that's pretty exciting. So let's say you see a $4 stock. You see a $4 stock and you buy 10,000 shares. 4 times 10,000 is $40,000. Now let's say that stock goes straight up to $5. It just screams right up to 5. And of course, given some of the charts you've seen already, you know that that's not impossible at all. It goes up to 5 and you sell it $1 a share, right? $5 times 10,000 shares is $50,000. You have made $10,000. 10,000 is profit. Okay. Now, while the stock, when it went from 4 to 5, increased by 25%, roughly, your account just increased by 100%. It went from 10,000 now to 20,000 because you were trading with leverage. You were using that leverage. You were leveraging the cash there or the margin to allow you to grow the account quickly. But remember, this is a sword that cuts both ways. If that same trade went down to 3, you sell it at 3 and you have just lost $10,000. While the stock has dropped from 4 to 3, and while that is a 25% drop or whatever it is, your account is down 100% because of the trade that you took on leverage. All right, so leverage is a sword that cuts both ways, but it is a tool that is at your disposal as a trader, and anytime you open a margin account, you are immediately extended this 4 times leverage. Again, though, you have to use that responsibly. When I have done small account challenges, the offshore brokers, all U.S. brokers, the most leverage they can give you is times 4. Offshore brokers will give you times 6. They could even probably give you more, but they can give you times 6 because they're not required to enforce the U.S. regulation. Even though they let you trade the U.S. market, they're not a U.S. company, so they don't have to enforce the U.S. rule. So when I traded it with an offshore broker, the first time I had a $500 account and I had 6 times leverage. So 5 times 6, right? You do the math. I had $3,000 in buying power. So now I have a lot of buying power, and very quickly I was able to start growing my account. On the first day, I bought 1,000 shares of a $3 stock. I sold it for $250 of profit, 25 cents. And just like that, my account's up from $500 to $750. Now let's do the math. On the next day, when I open my account, I've got $750 times 6. That's $4,500 in buying power. All right, so now I buy 1,000 shares of a $4.50 stock. It goes up 50 cents. I've made $500. The next day I've got $12.50 times 6. Now I've got $7,500 in buying power. And very quickly I was able to start ramping up my growth in the account. And just, again, my results are not typical. I always want to just say that because, I mean, that is the honest truth. I've been doing this for a long time. And even when I have done small account challenges, and I'm bringing up my metrics here to show you, I did them as someone who was already a successful trader. I did it as a challenge just to sort of prove that I could. So this is going to be the first month here of my small account challenge. And we'll look at this on a calendar. So day one, $158. One trade, 600 shares. So I got in and I got out. I made $158. Day two, day two, I made $12. Day three, I made 74. Day 4, I made 427. Now I started that month with $500. So just like that, my account has now doubled in 1 week. 353, 198. Okay, first red day, and then a big green day right there. Another big green day here, another one here, another one here, and then, I mean, look, that's a $19,000 day. So now we look at the sort of the equity and how it was ramping up, and this was in relation to my buying power getting bigger and me being able to afford more and more shares. So leverage and buying power is no doubt an incredible tool, and when used responsibly by someone who already has a proven strategy. In other words, you've already proven profitability, not just in a simulator, but even with real money, but without using leverage. It can be a tool that will help you grow an account. And I feel very confident now that, at any time I could start over with $500 and use that leverage and grow an account again. However, a margin call would be a situation where if you have a $25,000 account, you buy $90,000 worth of stock, which means you're using your leverage and margin. The value of the position drops to 50 grand. So you buy the $4 stock and it drops to $2. You take a $40,000 loss on the position. Well, 40,000 minus the $25,000 account, you're down 15 grand. That's a margin call. You're now in debt to your bank. Now, your bank doesn't want you to have a margin call. It's not their goal to give you margin so you can lose money. Ultimately, I think just like probably back in the 1920s, the goal of giving people leverage is that they help buy up the market. And so financial institutions benefit from a rising market. They want to give people the ability to fuel that rise in the market. But if you do make a mistake, you're now in debt to your broker. They don't just say, oh, your account's to zero. Your account can go negative, minus 15,000. Now, the $25,000 minimum has, again, as I said, been in place since 2001. And so that's called the pattern day trader rule. So let's get into that. The pattern day trader rule. You guys probably all know about it, but some of you may not. This rule was put into place in February of 2001, and it stated that if you're going to day trade more than 3 times a week using a margin account, you need a minimum of 25,000. It was to help prevent people from blowing up their accounts, and it was in response to, obviously, a lot of people blowing up their accounts through the dot-com bubble. All right, so this was a regulation to try to prevent and protect investors. So it states that if you day trade more than 3 times in a 5-day period, you have to maintain a minimum balance of 25,000 in the account. Now, just so you know, you can be holding $25,000 of stock. It doesn't have to be a cash amount, but it just has to be above 25,000. Now, there are several offshore brokers that allow traders to trade with margin accounts of as little as $500. And again, like I said, because they're offshore, they're not required to enforce a U.S. regulation on a minimum account size. That's only for U.S. residents. But if a U.S. resident voluntarily goes and trades with an offshore broker, we're allowed to do that. Now, almost all of those offshore brokers will make you sign kind of a little disclaimer that they didn't solicit you. That because the one rule is that they're not allowed to advertise to U.S. residents. Now, if a U.S. resident goes and opens a brokerage account there, that's fine, but they don't advertise. So this is why most beginner traders don't even know about this option. They don't even know that there's these offshore brokers because they're not allowed to advertise. They are only here through or grow through word of mouth. So and again, you guys can trade wherever you want. Just for full disclosure, I don't get paid by any of the brokers that I recommend. These are just tools that I have used. I do not care about like an affiliate revenue. So it's whatever you do is what you do. I don't really care. I just want you to be aware of the tools. So with the offshore accounts that let you trade with $500, you could set one up and you could have that either 4 times or 6 times leverage, depending on how you set up your account with them and how much you put into it. And you would be able to trade while under the PDT rule of 25,000 minimum that you would be enforced to hold if you were trading with a US account. But if you are below 25,000 and you don't want to use an offshore broker, then here are your options. Number 1, you only trade 3 times a week. All right, so 3 trades a week. Well, you see I usually trade 3 to 5, 10 times a day, but you could just trade 3 times a week. You'd grow your account slow and steady. You could swing trade, because if you hold a trade overnight, it's not a day trade. So you could hold trades overnight, but holding overnight carries a lot of risk. You could trade with options, which you'll learn as part of my swing trading and options trading course, which is sort of an elective after the small cap day trading course. Options settle overnight, so you could trade each day with options, but you can't trade options with margin and leverage. You can only trade them with your cash amount. And they can be quite risky. You could do a combination of all of the above. And what I would probably typically recommend for most traders is that before you really cross the bridge of making a final decision on what broker you're going to use, prove you can be profitable in the simulator. Because if you're making really good money in the simulator and you're trading 5, 10, 15 times a day, you're probably going to say, you know what, I think it's worth $1,000 for me to go open an offshore account and see how this translates to real money. And if it doesn't work out, it's $1,000, no harm, no foul. And if it does work out and I can grow that account to $1,500 to $2,000, then my buying power is going to increase. If I can slowly leave that account there and grow it to $3,500 to $5,000, with $5,000 times 6 times leverage, you've got a $30,000 account. You start growing it a little more. Maybe by the end of the year, whatever period of time, you get it up close to 20 or 25,000. Then at that point, you could move that account back to a US broker. But there are some traders that, even though they actually have enough money to trade in a US broker, they like trading with an offshore broker because keeping a small account keeps them grounded and keeps them focused and prevents them from making kind of crazy mistakes. When you have, a $25,000 account, 4 times leverage is $100,000. You could have a cat walk across the keyboard and all of a sudden be in with a $100,000 position with a hotkey. So the potential risk is certainly higher when you have that amount of money to work with. And so for some people, they feel that it's just better not even to have it at their disposal. And, if you're trading with a small account and the worst thing that happens is you blow up the small account, okay, so you blew up $1,000 account. It's hopefully not going to kill you. Whereas if you blow up, a $25,000 account and you did it with leverage and you have a debt to your broker, that could be more painful. Lewis says, my cat bought 4,000 shares once. And Vernon said, I had a cat execute a buy order. You guys think I'm joking. Cats are a menace. They really are. So anytime that I get up and walk away from my computer, I actually will minimize my broker screen. I've got 2 kids. The last thing I need is one to come over and start banging on the keyboard. I come back and I'm holding 150,000 shares of some stock and I'm down 50 grand. Trading is hard enough without those things happening. So in any case, there's certainly things you can do to be preventing silly mistakes like that from happening. But one step could be using an offshore broker and just always having a small account. So anyways, and again, word to the wise. So this is going to roll right into a question about, well, Ross, what is a round trip? So the language of the PDT rule, the pattern day trader rule, is that if you take 3 round trip day trades in 1 week, 5-day period, that if you take more than that, you'd have to be a trader. So sometimes people will say, well, okay, what the heck is a round trip? And to make things even more complicated, different brokers have decided on different definitions of what a round trip is. Most brokers consider the following a round trip. You buy 1,000 shares and you sell 1,000 shares. So let's just go in here. So PRQR. You buy 1,000 shares and you sell it. That's a round trip. Everyone looks at that as a round trip. There's no question about that. What's this? You buy 1,000 shares, you buy another 2,000 shares, then you sell it all. That was 3 orders, 2 buy orders and 1 sell order. That's still a round trip for most brokers. What about you buy 1,000, you buy another 1,000, you sell 1,000, and then you sell the rest? Now that's 2 buy orders and that's 2 sell orders. Is that 2 trades? Is that 1 trade? That again, for most brokers, is considered 1 round trip. A round trip. So let me help. This might clarify things. We buy 1,000 shares. We buy 2,000 shares. We sell 1,000. We buy back 1,000. We sell it all. That's 2 trades. That's 2 round trips. You changed directions twice. All right, so it's about how many times you change directions. All right, so you buy and then you sell. Doesn't matter if you buy 1, 2, 3 times. When you change directions from buying to selling, as long as you only change directions once, that's a round trip. So if you buy and then sell, well, this doesn't really work as a circle. I'm going to go back to the main screen. If you buy and then sell, so I'll do it on this. You buy. Where'd my drawing tool go? Okay, so you buy, you sell, round trip. You buy, you double, you sell, that's a round trip. You buy, you sell, round trip. You buy again, you sell again, second round trip. You buy again, you sell again, 3 round trips. All right? So if you're trading with E-Trade or Ameritrade or Lightspeed and you're under the PDT level, you have to be mindful of how many round trips you're doing. And actually, one of the nice things with TD Ameritrade is that they keep a count of how many day trades you have left. Because if you break that number of trades, what's going to happen is you're actually going to get a warning, and they're going to tell you, you can't trade anymore with us until you bring your account up to $25,000. And you can say, I didn't know about that rule, and they'll give you 1 free pass, but only 1. You get 1 free pass, and after that, they'll say, nope, sorry. You can either close this margin account and open a new account that's a cash account, or you got to switch to a new broker. You're done with us until you get above 25,000. So Ramiro says, Ross, say I buy 500, sell 250, then sell the other 250. Who can answer Ramiro's question? My man, that's 1 round trip because you bought and then sold. You only changed directions once. Now, if you bought 500, sold 250, bought another 500, then sold the rest, that's 2. So Gerald, you could buy 4 times and then sell 4 times, and that would be 1 round trip. Yep. But again, like I said, it's a good idea before you test that you try to, that you ask your broker for that clarification, because different brokers will be different. And Seth says he spoke with TD Ameritrade, and they'll actually give you 3 passes on the PDT a year. That's generous. I didn't know that. So they'll give you three get out of jail free cards each year. But I don't think you really want to abuse that. So that's what constitutes a round trip. Okay, so I think at this point, you should have a fairly good understanding of a cash account versus a margin account. You'll know that basically all of us trade in margin accounts. And the question is just, are you above the 25,000 mark or are you below it? If you're below it, you've got to deal with the PDT rule. Now, if you have a cash account, there's no PDT rule on a cash account. The PDT rule is only for margin accounts, but with a cash account, you've got to wait 2 days for settlement. So which is better? A margin account where you can only day trade 3 times a week, or a cash account where you could trade, if you wanted to, 5 times a week, you would have to trade with half the balance each day. So let's perhaps do the math on it. Let's just see, because ultimately the answer is how much money can you trade. So if you have a $10,000 account, 10,000, and you're trading with margin, you can take 3 trades a week. So that's $30,000 in cash that you can trade. Now, $10,000 divided by 2 is 5,000. So if you trade with a cash account, you could trade with $5,000 every day. 5 trades, 5 times 5 is 25 grand. So you'd actually be able to trade with more money with the margin account, but you'd be able to trade more often with the cash account. So it's hard to say which one is really better. But again, cash versus margin, and this was actually me doing the math for you. So, again, you're able to trade more money with a margin account, but then you always just have to kind of be mindful of not taking that last trade. And sometimes then you can't trade for a couple days, and then you might feel kind of disappointed because whatever. But on the other hand, with the margin account, You could just hold all your trades and then take all 3 of them in one day when you see something that's like really making a big move. So psychologically, this creates a challenge. So I'll just share with you that when I have done small account challenges below the PDT level, I would, because I knew I only had 3 trades a week in a margin account, I wouldn't want to waste the trades. And so I got to being so picky that I just ended up missing opportunities. And then I was like, oh, well, now I've missed it. And then if I would finally take the trade, I'd be like, well, now it's not going the right way, but I don't want to sell it because I'm going to lose one of my trades. I'll just wait for it to come back up. And then it goes lower, and then I take a bigger loss than I should have. Or I say, you know what, I'll just turn it into a swing trade. And so unfortunately, this whole margin issue, it can get into your head and then start to really throw off the way you trade because you're kind of battling this number. And that's not trading the market. That's just trading this, stupid PDT rule. And then likewise in a cash account, I had times where I would trade the whole account in one day, but I didn't really make anything, or I'd lose money, and then I wouldn't be able to trade the next day. Something would make a big move the next day, and I'd be like, oh my God. And then I'd finally be able to trade again on Wednesday, and by the time it's Wednesday, things are slow again. So in an effort to focus on trading the market you're in and not dealing with these kind of parameters that ultimately can affect your trader psychology, knowing how important our mental space is, again, I would come back to the fact that I think it's better to trade with a small account over at one of the offshore brokers where you can just trade as much as you want. And yes, you will pay commissions. You do pay a price for that. They're not free brokers, but I think it's the right move. And just on sort of a side note in terms of that headspace, I think there's a certain component. Sometimes they tell you, I don't know, you've probably heard this, but if you're in a bad mood, just smile. And if you smile for 15, 20 seconds, just smile. And you can actually kind of fake yourself out into feeling good. And so it's the power of fake it till you make it. Can you actually put yourself in the headspace of being a profitable trader, right? Can you get yourself so in the headspace that I am a profitable trader? This is what profitable traders do. They don't deal with this stupid PDT level. They've got $600,000 in an account. They've got big accounts. They don't think about commissions. They just get in, they get out. They trade like this. How can I get myself into that same headspace? The challenge is that once you're in the headspace of a successful, profitable trader, often you can do really well. But you can't get into that headspace until you're profitable. Which comes first? So that's where try to fake it till you make it. Survive till you thrive. Just try to, as much as you can, surround yourself with traders that are really trying and are profitable, and try to embrace that mindset. Now, the third account type is a retirement account. And there are, again, this is primarily for US residents. So I'm sorry for international traders, this may not be as relevant for you, but we'll just run through it. So we have in the US government-sponsored retirement accounts, and they're government-sponsored because the government has allowed us to not pay any income tax on those accounts while they're growing. So if you're trading in a retirement account and you make $100,000, you will not pay any income tax on that $100,000 during the year you made it. Now, depending on the account type, you may end up paying income tax on the distributions when you withdraw them from the account at retirement age. So the two primary retirement accounts are in this country a 401k, which is an employer-sponsored retirement account, but it can be self-directed if you're if you own your own business, you can create a solo 401k. And usually upon leaving a job, you could transfer the 401k into an IRA, which is an individual retirement account. Funds from 401k can be withdrawn and converted to the IRA, but when you eventually withdraw the funds from the 401k, when you're at retirement age, you would pay income tax on those distributions. But the idea is that at that age, you'd be in a much lower income tax bracket, and so therefore the tax would be more negligible, and it's not as big of a deal. And the reason that they do that is because all of the money that you put into the 401k, so if you make $50,000 a year and you put in $20,000, let's just say in the 401k, there's limits to it, but let's just say you're allowed to put that money away pre-tax. All right, so you put it away before they hit you with the tax. Now in an IRA, there's two types. There's a traditional IRA and there's a Roth IRA. Both have maximum contribution limits that change from year to year. They increase each year, every couple of years. They increase a little bit to just keep up with inflation. They don't go down; they go up. But a traditional IRA is the same as a 401k. It's deposits that are before tax. The account can grow as much as you're able to grow it, but when you withdraw, you do pay an income tax on the withdrawal. And then you have a Roth IRA. With a Roth IRA, your contributions are after tax. So you pay your income tax on your earnings, and then you contribute the post-tax amount into the Roth IRA. There are income limits to Roth IRAs. High income earners are actually not allowed to do a direct contribution to a Roth IRA. So, and I don't remember what the cutoff is. I'm sure some of you guys know exactly what it is if you're in the accounting world, but there is a max contribution limit. However, currently, and this may always change, but currently there is no limit on converting a traditional IRA into a Roth IRA. So if you've contributed $100,000 into a traditional IRA, you could convert it into a Roth IRA. And on the moment you convert it, you have to pay income tax on $100,000. So you're going to have an income tax hit. But then what you have left, since you've put it in after tax, all of its growth is tax-free. And then if you grow that to $2 million, when you start pulling it out, it's tax-free as well. And that's amazing. And so what a lot of people will do is, if you're like me, you're above the limit for doing a direct Roth IRA contribution, I would do a traditional IRA contribution and then the backdoor conversion to a Roth IRA. And so when I started my small account challenge with $583, that first year I made $325,000, and I took $6,000 of it and contributed it to a traditional IRA and then did a backdoor conversion to a Roth IRA. The next year I made $500,000 and I contributed another $6,000. The next year I don't remember, made like $360,000 and again contributed another $6,000 or whatever it was. $6,000 was about the maximum that you could contribute at that time. And then again converted that to the Roth IRA. So at that point I had about $18,000, which was about 3 years of contributions. And then even though I was below the $25,000 PDT level, I knew I was close. So I had the account with Lightspeed and I decided to start actively trading in it. Now, with a retirement account, you can get margin, which means you can trade 100 times a day, but you will not get leverage because they cannot ever let you be in a situation where you owe them money, because it would force you to make a deposit that is above and beyond the max contribution level. So with $18,000, I was able to trade 3 times a week. I didn't have any leverage, but I did have margin, what's called settlement margin. And I eventually grew the account to $25,000. And then once it was above $25,000, I was able to day trade with it as much as I want. And so that account is now this one right here. You can see it says IRA at the top. And anytime I trade in this, all the income is tax-free. I know when I start withdrawing it, when I'm 59 and a half, 60 years old or later, that the withdrawals will be tax-free. But since that money is locked up, I trade often in my margin account here. I didn't trade in it today because any of the profit that I make in this account, I can withdraw right away. But of course I would pay income tax on it this year. So we talk about taxes more in the Warrior Pro classes. And as I said in chapter 1, I think that it's a great idea for you to get into the habit of at least thinking about trading in a retirement account, which preferably would be a Roth IRA. But a traditional IRA is fine too. I mean, whatever you have, you might already have one. And if you already have one that's above $25,000, you could certainly use that. I want to be careful that I'm not recommending that you trade with your retirement account. I would not want to see any of you, because we know day trading is high risk. What I would be in favor of is you trading in a small account and setting up a new Roth IRA or something like that you just use for trading. So what you already have out there, if you have something out there, you keep invested long-term, benefiting from compound interest. But that you start to get in the practice of being able to trade a little bit in a main account and a little bit in a retirement account so you can start saving. So there's a question there. Michael said, I'm confused about the difference between margin and leverage. I thought they were the same. So margin is simply the ability for the trade to settle instantly. Leverage is when you have 4 times leverage. You'll never have leverage in any account other than a margin account. But as it turns out, you can have margin accounts that don't have leverage. And the only accounts that would meet that criteria would be a retirement account because they don't let you trade on leverage in the retirement account. And yes, the expression there is tax the seed, not the tree. So on a Roth IRA, you pay income tax on the seeds. So that initial contribution you had to pay income tax on before you made it. And then everything that grows from it is tax-free. So it's really a phenomenal government-sponsored incentive to save for retirement. Not all brokers will let you day trade in an IRA or an individual 401k. Some just simply won't let you do it. They'll say, no, we don't offer that. Lightspeed didn't offer that when I first started trading there, and I asked them and petitioned them. I said, you need to offer this because I want it. And so I said, listen, if you don't offer it, I'm going to go somewhere else that does because this is important to me. And they were like, well, we don't really want to lose Ross. He's obviously a great client and he, of course, recommends us. It's so much great exposure for us. So they actually changed. They went through their compliance process. They went with their clearing firm and they set the path and made it now possible so you can trade in an IRA or an individual 401k and traditional or Roth IRA with Lightspeed. So it's now available. And with a flip of one button, just like that, I could trade in between these two accounts. So, again, this may be a little ahead of where some of you guys are at. Lightspeed, you can use, a lot of international traders will trade there. But of course, if you're international, you wouldn't have the benefit of the 401k and the IRA. So I think that probably covers it in enough detail. I hope that this is helpful. So thoughts on a SEP IRA for self-employed? I don't see why that wouldn't work with Lightspeed, but you just have to call them and ask. I know they let you do the individual 401k if you're self-employed, so they probably would allow that as well, but you just have to check with them. And Miles is saying, do you have any kind of tax workshop? So in the Warrior Pro class, we have an entire chapter dedicated to taxes. And I'm obviously not an accountant. I can't provide you legal advice. I can't provide you tax advice. I can't even provide you financial advice. I can only share with you what I know and what works for me. So I'll share with you what I know and what works for me from a tax perspective. But ultimately, because there's so many variables in taxes, state, country, everything else, you will need to go and talk to some type of accountant to make sure you're making good decisions for your specific situation. So I'll just leave it at that. Okay, so let's continue on here with Chapter 3, Part 2, choosing a broker and opening an account. All right, so we're going to keep going here. Chapter 3, Part 2, choosing a broker and opening an account. And again, not to put the cart ahead of the horse. I always screw up things like that. But anyways, so today's lesson, why is a broker required and what do traders need in a broker? So why is a broker even required? Well, a stockbroker is an intermediary. So when you fund an account with a broker, they are the ones that give you access to buy and sell shares from the exchange. You can't walk down to Wall Street and say, I want to buy 1,000 shares of IBM or whatever. You need to go through an intermediary. The intermediary traditionally, and just so as just to share a little anecdote with you, a little story. When I was younger, and Uncle Steve, you may know this. Uncle Steve's of course with us today. I had an interest in the market. There were some folks in our family that had made money in the market, and so I thought, gosh, if they could do it, maybe I could. And so when I was probably 12 years old or 13 years old, I wanted to buy stock in the American Ski Company. I was a skier. I thought that was an awesome idea, and I don't think they're even still listed. American Ski Company. So what American Ski Company was one of the largest operators of alpine ski, snowboard, golf resorts in the world. That's a big was. I think they may have gone bankrupt or I don't know what happened. But anyways, so they might have gotten delisted. So anyways, so I thought because they were a pretty inexpensive stock, I was like, I want to buy, $100 of American Ski Company. And my parents thought, okay, this is a nice idea. He wants to buy some stock. So there was an Edward Jones office down the street. And so I called them. I said, I want to buy $100 of American Ski Company. And so they said, okay, that's fine. That'll be, we charge a $50 commission to buy. Well, we also charge a $50 commission to sell. You still want to do it? And so that was the end of it right there. My $100 is gone. So in those days, and that was in the late 90s, just going to a financial advisor like that, because Edward Jones, of course, had people down on the trading floor, and they would call them and say, hey, we've got this person who wants to buy 100 shares. And then that person would go walk over to where American Ski is trading and buy the 100 shares. And, I guess even in that time, it was starting to get digital, and they probably could have done a digital trade, but they still charged $50. So I didn't take my trade. Well, fast forward a couple more years. Now, what did I do with this? Fast forward a couple more years to 2000, 2001, and I wanted to get into the market again. Now, hold up one second. I'm looking for an important piece of paper here. So fast forward a couple years, and I opened up my first account with Ameritrade. So this is my Ameritrade statement right here. This is actually from 2004, but this is the same account. So this is, I don't know, so that's an old Ameritrade statement. I set up my Ameritrade account. I put about $1,000 into it. You can see the cash balance on this account was $1,046. So not a lot of money in it. And I wanted to start trading. And so I started, buying stocks like this is, let's see, NABC. I bought it at $13.95. And I bought I bought US Steel, and I bought American Electric Power, and I bought, ExxonMobil. And I did it kind of as a summer project. I thought, I'm going to be the kid that's buying stocks during the summer. I'm going to come back in the fall, and I'm going to have, struck it rich. Well, of course, in those days, Ameritrade charged you $10 or $15 for every trade you took. With a $1,000 account, I wasn't able to make any progress. And the stocks I was trading, they weren't moving enough. And so, I just was not able to be especially successful. All right, so, and part of the challenges in those days were just simply the issues with brokers. But you do have to go through the broker, you have to go through an intermediary, and ultimately competition among the brokers in the last 15 years has been a big win for retail traders like us, because it's forced brokers to lower their commissions all the way to the point that many have zero commissions. And it's forced them to provide and build out and invest in better and better platforms and software and mobile apps and everything else. And no doubt, TD Ameritrade, who just was bought by Charles Schwab, has become a big player in the brokerage industry. So a broker is required. I have understood that with some countries, your savings and loan bank can place orders for you, but that's not the case here. So as a day trader, and let's get back to focus. We're all trying to be we're day traders here. So what do day traders need in a broker? Well, we need fast executions. And, just as an example, this is PRQR. Watch, I'm going to press the buy button right here. See, that's instantaneous. I'm going to press the sell button, instantaneous. Now, they used to say you'll have no commission if the order takes more than 1 minute to execute. Well, 1 minute to execute? You got to be kidding me. That's unacceptable. We need instant, sub 1 second executions between pressing the buy button and the order getting filled. So why would some brokers be fast and some be slow? Well, right here, as you can see, so number two, we know that we need a reliable and stable trading platform. And so generally, I'm not going to want to use web-based trading software. I don't want my browser to crash on me. I'm going to use a software that I install on my computer and that runs really well and is pretty lightweight and just very quick. TD Ameritrade's desktop software is a little bulkier. It's very sophisticated, but it's a bit of a hog on the resources on your machine because it's just so sophisticated. I prefer something more lightweight and nimble like Lightspeed or the Sterling software here. And then number three, direct access routing. So not to get too over your head or ahead of ourselves on level two, but this right here for RHE, this is where everyone that wants to buy and sell this stock has to come right here. This is a little island for this stock. Now, remember yesterday when I talked about cryptocurrencies and how different crypto exchanges will have a different price for that currency because it's so decentralized. Well, the nice thing about the US market is that it's very centralized, and everyone who wants to trade this stock trades it right here. BBIG has 179 million shares of volume. Everyone who wants to trade it trades it right here. And so you see ARCA, ARCA right there, ARCA. Well, ARCA is one of the electronic communication networks that you can send your order to. So essentially that's the computer, and anyone that wants to send an order to ARCA can send an order, and ARCA, as a market maker, has an obligation to give you the best price currently available at the second they receive your order. So since I see that ARCA and NASDAQ are both right here, ARCA and NASDAQ, they're pretty much right there, I can choose to send my order directly to ARCA or NASDAQ. I can send it directly to the market, and my execution will be instantaneous. Just watch this. Just for the heck of it, I'll just do this as a market order. I don't usually do market orders, but let's just do it for the heck of it. Look at that, 1 share in and out. That cost me $4. $2 in, $2 out, that's my commission. But you know, whatever, it doesn't matter. That's instantaneous execution. So that's direct access routing. But you know, what a lot of brokers offer is smart routing. Now, you can see these little bunny ears. Smart routing is not always that smart for you as a retail trader. What smart routes often do is they route your order through a market maker, one of these networks, that the broker has established a relationship with, right? Now, if you're a market maker, you want to receive volume because you charge a certain amount for people to use your their service. So they'll come up with these arrangements where they'll accept all of the order flow from a certain broker. And this was something that was happening with a broker. I won't name names at one point, but was an issue. So they were basically selling their order flow through one of these specific routes. And then that specific route was giving hedge fund traders the inside scoop on where the volume was, where the order flow was going. So that gave those hedge fund institutional traders kind of a leg up on seeing, how the market was working. And now that was all disclosed in the terms of use. You were getting a free execution. You were getting a free execution, and you were, in exchange for that free execution, I guess you helped a couple institutional traders see what was going on in the market. No harm, no foul. But let's look at my metrics for just one moment here. I think you may have noticed this, or I may have mentioned it. But just back here, this is back to the December challenge I did. So during this December challenge, I made $57,000, and I was trading with 34,000 shares of volume total. So that meant I bought about 17,000 shares, and I sold 17,000 shares. So when I bought those 17,000 shares, let's say because the order route was slow, and I didn't fill at 6, but I filled at 604. Let's say I filled 4 cents higher. 17 times 4, that's $600. I just lost $600 because of slow routing. Let's say I go to sell it, and the same thing happens when I sell, and I just lost another $600. The difference between making money and losing money, my average daily gain was only 19 cents per day per share during that small account challenge, and I made 57,000. So if I lose 5 cents off the top and 5 cents off the bottom on every trade I take just because of routing, that could right there be the difference between success and failure. Now, ultimately, there may be times where, it's not to say that there aren't traders who are profitable using smart routing, because there are. I've definitely, we've got students, we have several 100K club students who are trading with a broker like TD Ameritrade, or actually with TD Ameritrade, and they're perfectly profitable. So, the 1 cent or 2 cents here or there, maybe it doesn't really hurt them. But in my opinion, you want to set yourself up for success. And so part of setting yourself up for success is setting the bar low, making it easy for you to be successful. Why are you trying to compete, in the Tour de France with, 30-pound lead weights, strapped to your ankles? I just don't see, well, maybe to your ankles it would make you pedal faster, but I don't know. I don't really know. But let's just say, I don't see how it's going to be helpful if you're not taking advantage of every opportunity to try to improve your odds for success. So fast executions, reliable, stable software, and preferably direct access routing, which is available with Lightspeed. You can choose and opt into direct access routing with TD Ameritrade. You can opt into it with E-Trade, although it's not standard. You can select it, and I think you may have to call them to enable it. They'll make you pay a little extra for it, but I think it's worth it. And then number 4, hotkeys or hot buttons. So hotkeys is an ability to press Shift 1, just like that, Shift 1. So I'm holding on the Shift button and I'm tapping the 1 button. And just like that, that order's going through. Control Z, my order's gone. So I trade with my hands in terms of, I don't have to use the mouse. I just press buttons and the orders go through. Not all brokers even offer that functionality. So hotkeys are important, and then hot buttons would be something like this. This is an actual button right here that you can click and press. So hotkeys and hot buttons can allow for faster trading, which is, again, only going to help you. And then discounted commissions. While it's certainly nice to have a broker that has zero commissions, the reality is usually you're paying for what you get. And so you have to handle what the sacrifice may be of that zero commission broker. Maybe it's not that bad for you, but maybe it is a problem. So I pay $2 a trade. That's the Warrior Group rate over at Lightspeed. If you trade more actively, you can get that rate reduced even more, but you've got to trade really actively to get that. I think they'll go down maybe to $1 or something like that. But you'd have to be trading millions of shares a month, so that's probably not going to be where most of you guys are at. And then some of the offshore brokers will offer discount commission rates. We have some group rates at different brokers and stuff like that, but you don't want to be paying $5 or $10 a trade. That's something you really want to try to avoid for sure. But that shouldn't be a problem given the current competitiveness of brokers in the market. All right, so with that, that's chapter 3. So we talked about obviously account types and what you need in a broker and what type of broker you want to use. And obviously I'll leave it up to you to make that decision. And I would also emphasize that you don't have to make the decision today. You will probably feel more comfortable making that decision once you've already got some experience under your belt trading the simulator and realizing maybe how much you like this type of software or Lightspeed or whatever. Or if you're using TD Ameritrade and you've been using it forever, by all means, you can keep using it. I'm not saying you can't. And I'm not saying that no one's ever been successfully day trading using that, because there are. But I think you just, it's one of those things that, again, I want to make it as easy for you to be successful as possible. So with that, let's continue on to chapter 4, where we're going to get into fundamental analysis.